prices are down after speculation of a ceasefire in the Middle East.
Tariffs. The word tariff to me is the most beautiful word in the entire dictionary.
They're going to tariff the hell out of them.
I am a tariff man.
A bit of, rinse, wash, repeat, that cycle going on again.
Even more of a negative downward pressure on U.S. economic growth.
Experts are warning this could eventually impact our wallets.
Yeah, this could directly impact our wallets.
The idea that the US president has a figurative energy valve beneath the Resolute desk, capable of controlling energy flows and prices with a simple turn, is a persistent but misleading narrative. This belief seems to underpin some of the rhetoric from Donald Trump's administration, particularly in the energy policy domain. Recent statements by the former president and his appointees highlight misconceptions about the complexities of energy markets, the US energy system, and its interplay with global economics. A striking example is the 3-3-3 plan proposed by Scott Bessent, Trump's pick for Treasury Secretary. The plan promises 3% economic growth, a 3% federal deficit, and an additional 3 million barrels of oil equivalent production daily. On the surface, such a proposal seems ambitious, even optimistic. However, a closer examination reveals several flaws in its assumptions and feasibility. The energy production goals in Bessent's plan appear to misinterpret the trajectory of the US oil and gas sector. The inclusion of barrel equivalents, a term that converts natural gas volumes into oil barrel energy equivalents. 6,000 cubic feet of gas equals 1 barrel of oil, hints at the integration of liquefied natural gas, LNG, into these calculations. While the US has been expanding its LNG export capacity, with 12.6 billion cubic feet per day under construction, equivalent to 2.1 million barrels of oil daily, this growth is largely anticipated by the market and aligns with existing projections by the International Energy Agency, IEA. For Bessent's plan to deliver an additional 3 million barrels beyond these anticipated figures, a dramatic and unlikely surge in drilling activity and infrastructure development would be required. Moreover, US oil producers have shifted their focus in recent years from maximizing output to prioritizing profitability. This discipline, driven by lessons from the shale boom and subsequent bust cycles, has ensured that shareholders see returns rather than unchecked expansion. This shift in strategy explains why the US reached record oil production levels under President Biden without the drill, baby, drill mentality once prevalent in the industry. Despite a favorable geopolitical landscape, including recovery from the pandemic and the Ukraine war-induced energy crisis, production gains remain modest. Structural factors such as softening demand in China, declining US consumption, and OPEC Plus withholding more than 6 million barrels per day of spare capacity further constrain the market. Simply opening more federal lands for drilling, which accounts for a minority of US output, would do little to significantly alter these dynamics. Trump's tariff rhetoric also complicates the energy landscape. His threat to impose a 25% tariff on all products from Canada and Mexico would have immediate repercussions for US energy security and economic stability.
Tariffs. The word tariff to me is the most beautiful word in the entire dictionary.
They're going to tariff the hell out of them.
I am a tariff man.
Canada and Mexico collectively account for 70% of US crude oil imports, with Canada alone supplying over 4 million barrels per day. These imports are essential for US refiners, who rely on heavier crude grades from these countries to balance the lighter shale oil produced domestically. Slapping tariffs on Canadian oil, such as Western Canadian Select, would raise costs for refiners and ultimately consumers. This impact would ripple across the Midwest, driving up fuel prices. Furthermore, The US cannot simply replace these imports with domestic production, as US refiners require the heavier grades that Canadian and Mexican oil provides. Paradoxically, Trump has also floated reviving the Keystone XL pipeline, designed to transport Canadian crude to US refineries. Such proposals conflict with the tariff threats, highlighting a lack of strategic coherence in these policies. Additionally, tariffs could revive retaliatory measures like those seen during Trump's first term, when duties on steel raised costs for LNG developers, and China halted US LNG imports for much of 2019. Such moves undermine US energy exports and the broader trade relationships critical to sustaining economic growth. The broader issue lies in the disconnect between Trump's energy ambitions and market realities. His vision of surging production, lower energy prices, and a rejection of international trade agreements is inherently contradictory. Energy markets are global and interdependent, driven by economics rather than political mandates. While the US is a net exporter of oil, its refining sector continues to import more than 6.6 million barrels of crude daily because optimizing margins demands access to foreign oil grades. Proposals like Besant's plan or Trump's tariff threats fail to account for these complexities. They also ignore the broader policy objectives tied to energy security, environmental commitments, and economic stability. For example, the Strategic Petroleum Reserve, SPR, releases under Biden were criticized by Republicans. Yet constraining oil trade with Canada and Mexico would have similar destabilizing effects, forcing reliance on other less secure sources. The energy proposals emerging from Trump's camp appear more like political posturing than viable policy frameworks. The 3-3-3 plan and tariff threats betray a fundamental misunderstanding of energy markets and their interplay with trade and security policies. Real-world energy dynamics do not align with the simplistic valve model. Instead, they require nuanced approaches that balance production, trade, and environmental considerations. Energy markets are dictated by supply-demand fundamentals, not political decrees. While rhetoric may win headlines, implementing such policies could jeopardize US energy security, raise consumer costs, and strain critical trade relationships. For a country that prides itself on energy independence and leadership, this oil and gas math simply doesn't add up.